Hey, what's up, guys? Justin here, confidentoptions.com. Today is Sunday, August 26th. Tonight we're looking through trades, or a couple of our trades that we closed the week of 8/20 through 8/24/2018. So let's jump right into it. I'm on the trading tab here, and I'm just going to go at the website, and I'm going to go to close trades by clicking on the icon, and this will pull up our last 30 days of closed trades. We try to keep this updated at least on a weekly basis, if not each day. That way you guys can see kind of what we're closing out, what we're trading. Soon enough, we'll have live trade alerts that we'll be offering that you'll be able to get the opening and closing trade notifications. That way you guys can learn in correspondence with the basic course that we're putting together. So lots more to come this year, and we'll keep working on that for you guys. But tonight's review, we're going to go through the trades from last week. And so we had a total of 9 closing trades last week, 8 wins and 1 loss. And we're going to go through 4 of the trades that we have just to make sure this video doesn't get too long. So the first closing trade we had was an EWW Strangle. We're not going to go into this one in detail, but it's a good case study. I think we'll do a kind of a whole segment of its own on this. 3 adjustments on a roll got us basically back to a scratch trade on this, a small loser. Just so you guys know, anything that's a 1 contract between minus $10 and positive $10, we consider a scratch. And so if you look down here, it was like an $8 per contract loser. So that's why it's considered a scratch, just if you guys are curious. If it's below, if it's greater than a $10 loss, then it becomes a loss, classified as a loss. And if it's greater than a $10 per contract win, then it's classified as a win. But anyway, this will become a good case study for us. I think, we get a lot of questions about, well, why do you trade options? Isn't it a zero-sum game? I mean, you're trading on probabilities, but the market's so efficient that those probabilities typically work out to be 0 or blank, right? I mean, if you have a 30% chance of winning, or if you have a 70% chance of winning, and the 70% chance of winning returns you $30, isn't the time that you lose, the 30% of the time that you lose $70 going to eat up all the $30 losers? Well, this is a perfect example why that's not true at all, and because we adjust and roll and continue to maintain positions, and taking us from a complete loser in this case to a scratch trade, basically just break even, get out of the trade, and move on to the next. So cool case study. Take a look at the trade tab, or the closed trades, and then you can see kind of our entries and adjustments. And we want to make this to be as clear and concise as possible. So if you have any questions, of course, let us know. There's a comment box at the bottom of the page. First trade we're actually going to review, though, is our Strangle in SMH. This was a core portfolio position, meaning that we've entered it as part of the core portfolio, expecting to hold it for our typical duration is about 15-20 days, and our profit target is 50%. So we you can see here we exceeded that. We opened for 206 back on the 1st of August and closed it on the 21st for $1.01, so a little bit over that 50% mark. 114 call and 99 puts, and bought them back to close. And so you can see kind of based on your portfolio size what the potential profit could have been. Let's jump over to the charts. We use Tastyworks here. We also use Thinkorswim. If you have any, I've fielded a few questions from you guys on the conversation between Thinkorswim or Tastyworks. Let us know if you have any questions on that. We'll be happy to answer our opinion at least. So this blue line here is where we entered the trade. So that represents our entry date of August 1st. And so what we did is sell the 114 call above the market. Let me expand this a bit so that we can get both of our strikes in view. So we sold the 114 calls up here. So this is our call side. And we sold the 99 puts on the bottom side, so just below this 100 handle. So that's our put side. So nice wide range. The stock was trading right here when we entered the trade. Kind of a doji candle there. So we entered the trade. Oops, sorry about that. At least we can kind of see what we're doing here. There we go. And so we had plenty of room for the stock to move. It did end up moving kind of towards us, or towards one of our strikes. It gapped back down pretty hard. It moved back up. This is truly random movement. It's perfect cyclicality. It basically finished exactly where we entered the trade. So it's exactly what we want to see. Hardly any movement in the stock in the end, and yeah, it worked out for us. So we were able to close pretty much typical time frame for each of our trades. So good trade for us there. We're happy with it. and we'll book it as a winner. Moving on to the next. Our one loser this week was in Toll House Brothers. Sorry, I'm not sure why that keeps popping up, but not Toll House Brothers. Toll Brothers, home builder. We had a decent sized loss in this, and guys, this is just part of the game, part of trading. It's nothing to get emotional about. It's nothing to, get too drugged down by. Of course, it's tough, but that's part of the game, and that's why you keep trading and you continue to stay mechanical. We sold the earnings strangle on the 20th of August on this guy. The expected move was $1.85, as you can see here, but the stock moved almost double that at $3.49. This actually represented the largest move that the stock had ever made. So we did have the edge going into this, where the market maker move was greater than the one standard deviated move of all the past earnings events. This ended up blowing that completely out of the water, and so we went right into defensive mode. Didn't get too emotional about it. Just said, all right, what do we do? So what we did was the stock moved to get us on the top side, which is our call side, which we'll look at the chart here in a moment. So we ended up moving the 32.50 puts. We closed them out, and then we sold the 38 puts, just moving them right in. This means we were in a dollar inverted, meaning our puts were higher than our calls. So the smallest or the least amount that we could have closed this trade for was $1, which was fine. The only thing that the main goal is obviously to reduce the bleed, right? And so we would collect 11 cents per contract additional to the 65 cents that we opened the contracts with. So that continued to let us take in credit and kind of pull down the loss a little bit. So we were looking at a pretty good size loss. The next day, luckily, the stock pulled back, and it also continued to pull back. But of course, hindsight is much better than foresight or what's happening at the time. And so you take what the market gives you when you're looking at these things. So that's kind of big, but we'll go with it. So here's the day before earnings. We did our analysis. We got in the trade right at the close, and we sold again the 37 calls. So right up here, 37 is actually exactly where the stock is right now, and down below the 32 puts, 32 and a half. So we'll call it 32.5. And up here we had the 37s. Great big range, larger than 65% of the past move. So we're feeling pretty good about it. It opened up way out of side of our 37. So the mechanical thing to do is to move up your put side. Now, after the earnings event, the IV gets sucked out of the contract. So there's not a lot of meat left on the bones when you do these. And so that's why we had to go inverted. And so what we did is we closed this out. So we said, all right, let's close this out. It's worth nothing. And let's open this up here. So this is what we mean by inverted. Our put, we have the 38 put, is above our 37 call. So the least amount of money that I could close this trade for is the difference between the inversion or $1. Remember, I only collected 55 or 65 cents, and then I collected another 11 cents. So I would have been 77 cents, and I would have been able to close it. The smallest I would have been able to close it for $1. So yes, this is essentially locking in a loss, but we have to go into defensive mode and take in more premium to be able to kind of stop the bleed, right? So the stock, the very next day, it closed decently strong. So you can see it kind of closed the top of the wick. The next day, it just completely collapsed. It gave it all back, and that's exactly when we took the trade off. We were able to take it off, I think, for like $1.90, a little maybe above $1.90. So decent size loss still, but without the move up and without the patience that we had to wait until the next day, it would have been probably double the loss that it was. So this is exactly how the way you defend these things. Of course, in hindsight, I wish I would have been a little more patient. So it's a good learning thing when a stock moves this far out of the expected move or the expected range. There's going to be people taking profits. There's going to be people that are contrarian traders that come in and short the stock. And the stock's been beat up pretty good. So this move up here was a little bit of a mix between a short squeeze on the positive earnings. It's just been getting crushed. A little bit of short squeeze, maybe some intraday traders coming in, swooping it up. It had a biggest move it's ever had, and so that it's going to go off on a lot of people's radars as a play for the day if you're a kind of an intraday trader. So that's exactly what happened. But then, people are going to fade this move into these resistance points, resistance here. So I thought this point could hold kind of give you some psychology of why I took the trade off when I did. I thought this point was going to be where it would bounce again, because there's a ton of resistance here, which turns into support. So that's the place where I thought maybe it could do some jumping, and I didn't want to hold the trade any longer. So as it moved in and got crushed, we just went ahead and took it off. Took the gains back that we could. I think we kind of brought back $400 or $500 in the trade, and so best thing we could do is get out of it, and that's what we did. So we're happy with it. Obviously not happy with the trade because it was a loser, but we're happy with the way that we managed it, and we would do it 100 times over again. So I hope that's a good learning opportunity. These things are going to happen, and so it's more about how you deal with the losers than it is how you deal with the winners. Next trade we're going to look at is a pretty good case study of its own. AABA, we're pretty versed in trading this stock. The spreads on the bid-ask spreads aren't the best, but it does oftentimes get real high jumps in volatility, which is exactly what we had here. So we entered this thing when it had like 90 or 80 some IVR rank, and so that means there's a ton of premium in the contracts. That way we can sell high and basically cover low, and so that's the whole point. And so what we did is open on 725, the strangle, 85.69. We ended up adjusting it here once. We then rolled it when we were at the 20 days till expiration, and then we adjusted it again. And each of these adjustments is pretty minor for how much the stocks move. So we only moved it $4 down here. When we rolled it, we couldn't get the exact same strike, so we kind of shifted the whole position to 80.70. We only moved it down $3 here. So we make little incremental adjustments as the stock moves against us. It allows us to continue to book premiums, right? Book 37 cents, book another $1.20, book another 30 cents. So essentially our total credit here was gaining over, I think we got in over $3 or so. And so when we close it out at 2, although it's not 50%, because we've rolled and because we've adjusted so much, it's a good winner, and it represents almost a 13% return on capital. So a little bit of patience here, a little bit of mechanical trading turned out to be exactly what we needed. So let's jump over the stock chart. So I marked this one up to keep us straight, but what we originally did, I should have written that down, but what we originally did, the 85.69 and then moved the 85 to 81. So 85.69, let's get this centered up. And you can see how wide these ranges are, just because the stock can move quite a bit. And we adjust pretty aggressively on this just because we know that the stock can move, and so we're pretty aggressive when it comes to movement or to adjusting the stock. All right, 85.69. So let's get that one centered up right about there, and then we'll draw in our 69. So we entered this one a little bit later in the day, so right here. So we were perfectly centered when we got into the trade. The stock then started to move against us after this big jump here. It started to move down. And so immediately as it approaches our 69 puts, we want to start rolling down. We leave this side as is. There's nothing we do here. Leave it in. And so what we do is start moving down the calls. And so what we did is go from 85 to 81. And close this out and collected more credit. So because of that, that pushes out our break-even point on this side. On this date here, it was not a full loser because it hadn't breached our put strike yet, but we were at that 20 days till expiration mark, and so we rolled it out to the next expiration cycle. And again, we had to adjust slightly because those strikes weren't offered in the next cycle, so we actually ended up moving this down to 80. And then moving this down by $1 to 70, or moving it to 70. It actually kind of went up. Because of all the credits we've taken in, it was actually still a credit to move those up by rolling it out, so no harm, no foul there, and this becomes our put. So it actually was almost in the money at that point. So the stock continued to move against us. We moved this call down one more time, a couple bucks here. We're just stair-stepping it down, and then we became opportunistic like we always are, and we were expecting cyclicality. After this move like this, we want to see some cyclicality in the stock. It ended up giving exactly what we wanted, moved back up, jumped up big one day. So it closed here and opened up here, and we were opportunistic about that, so that it was right between our strikes, and we went ahead and closed out the position and took in our profits and moved on to the next. So kind of cool to see how we kind of stair step as the stock goes. We kind of move with it, and that's one of the beauties of options, is it gives you that ability to kind of adjust and do whatever you need to do to just track the stock as it goes. And we want to be not super aggressive on our adjustments. Like, I wouldn't want to roll the 85 down from 85 to like at the money to 69, because I know the stock moves so much, but I do want to continue booking in credits, and that's what this is doing. Credit, credit, credit. And so what you do is add all those up, and you subtract that from the amount it took to close the position, and the leftover difference is your profit. So even with a small position like 3 contracts, it would have been a nice $300 winner. You know, we close these kind of singles and doubles. We don't do the home runs. We close them off one by one, and we slowly continue to take profits, and that's how we remain profitable, regardless of what the market's doing. Last one here, I know this is kind of a long video, stick with me, is going to be WYNN. So we noticed the stock had a pretty good rundown, and our technical signal started signaling on this candle here that the stock was ready for either a slowdown in this momentum or a kind of a reversal, and we got the reversal end of the deal. And so we entered here, and we entered the 135, 130 put spread. And so that's when you sell the put closest to the market, and then you buy the put further away. It makes it risk defined. So really, really cheap trade to get into, and you'll see our return on capital here in a minute. But I think it was like, I want to say $300 or $400 per contract to get in, and we made a good amount on that money on the back end. So what we ended up doing is getting into that, and as soon as it gapped up the next day, we were pretty confident in the position, so all we had to do is just wait for it to collapse 50%, and it did, because it kind of stayed up here. It has a really strong day this day, and it gave us the opportunity, I think, when the candle was almost up here, to get out. And we usually put our orders in, you know, on the weekends or whatever, so they can just sit and be ready at our targets. And so when the stock moved up, you know, I don't have to sit here and watch it. I just, when it hits the target, it gets filled, and we get out of it and move on to the next. So that's when we got out of the trade, and we closed it out for a nice profit. So wrapping up, that is the last trade we're going to look at. Oh, I was going to look at this. So 4 contract position would only cost you about $1,500. So nice return on capital, making $260 on $1,400, basically $1,500 put to work. So that represents about 17.5% ROC. So love seeing those big numbers on these credit spreads. They are a wonderful part of our strategy, and we look to enter at least a new credit spread as many times as we possibly can, just because they're such cheap trades. It doesn't take a ton of your portfolio power to do them, and they typically return a good amount on that capital that you put to work. Hope you guys enjoyed the video tonight. Hope you have a fantastic week, and we'll be seeing you again soon. Talk to you later.